Have you ever wondered how to analyze an income statement? Well, you're not alone. An income statement, also known as a profit and loss statement, is a financial document that companies use to illustrate their financial performance over a certain period of time. It's like a report card for businesses, showing revenues, costs, and profits, among other things. Why is it so important, you ask? Well, it provides crucial information about a company's profitability and financial health, making it a vital tool for investors, managers, and anyone interested in understanding a company's financial performance. Plus, it's a legal requirement for public companies, so it's a pretty big deal. In this video, we're going to break down the analysis of an income statement into easy-to-follow steps. We'll delve into the components, assess revenues and costs, and evaluate operating expenses and net income. Understanding an income statement can seem challenging, but with the right approach, you can grasp it. Stay tuned as we demystify the income statement. The income statement has several key components that we need to understand. First up, we have revenues. This is the money that a company generates from its business activities. It's the starting point of the income statement and is often referred to as the top line. Revenues could come from selling products, providing services, or even from interest and dividends on investments. Next, we have costs of goods sold, often abbreviated as COGS. This represents the direct costs of producing the goods or services that the company sells. This could include material costs, direct labor costs, and other direct costs related to the production of the goods or services. Subtracting the costs of goods sold from revenues gives us the gross profit. This is a good indicator of a company's fundamental profitability before overhead costs are taken into account. Following gross profit, we have operating expenses. These are the costs associated with running the business that aren't directly tied to production. This includes expenses like salaries, rent, utilities, and advertising. The difference between gross profit and operating expenses gives us operating income. This represents the profit a company makes from its core operations, excluding any interest and taxes. Finally, we reach the bottom line, net income. This is the final profit or loss after all revenues, costs, and expenses have been accounted for. It's often seen as the most crucial number in a company's financial statements as it shows the company's bottom line profitability. So to summarize, we start with revenues at the top. We subtract the cost of goods sold to get gross profit. From gross profit, we subtract operating expenses to get operating income. And after accounting for interest and taxes, we reach the net income at the bottom. Understanding each of these components is crucial because they provide insight into different aspects of a company's financial performance. They can show where a company is making money, where it's spending money, and ultimately, whether it's profitable or not. These are the building blocks of an income statement. Next, we will dive deeper. First on the list is revenues. Now, revenues are the income that a business earns from selling its goods or services. It's the top line of the income statement and gives us a snapshot of a company's financial performance. But how do we analyze it? To start, we look at revenue growth. This is where we check if revenues are increasing over time. A steady upward trend is a good sign, indicating that the company is growing and attracting more business. Next, we consider revenue stability. Are the company's revenues consistent from quarter to quarter, or do they fluctuate wildly? Consistent revenues suggest a reliable, steady business model, while large fluctuations might raise some red flags. But it's not just about the numbers. We also need to understand the sources of revenue. Are they diversified, or is the company overly reliant on a single product or service? Revenues give us the first glimpse into a company's financial health, so it's an essential part of our analysis. Now let's turn to costs and profits. Diving into the heart of any income statement, we come across the costs of goods sold, or COGS. This line item is a reflection of the direct costs associated with the production of the goods or services that a company sells. It's the raw material, it's the labor involved in manufacturing, it's the direct expenses that fuel the engine of production. Now, subtracting the costs of goods sold from the revenue gives us the gross profit. This is a preliminary measure of profitability. It's a quick snapshot that tells us how efficiently a company is using its resources in the production process. A higher gross profit is always a good sign. It means that the company is either achieving higher sales or it's keeping its production costs under control, or both. But don't stop there. Gross profit is just the beginning. It's the first step in the journey towards net profit. It doesn't consider the overheads, the administrative costs, the sales and marketing expenses. It's like judging the health of a tree by looking at its trunk while ignoring the roots and the branches. Now let's talk about the relationship between revenues, costs, and profits. It's a delicate dance, a balancing act of sorts. The revenues are the incoming cash flows from the sale of goods or services. The costs are the outgoing cash flows, the expenses incurred to generate those revenues. And the profit? It's what's left when you subtract the costs from the revenues. But here's the thing, the dance doesn't end there. The profit isn't just a static number, it's a dynamic entity, constantly changing, constantly evolving. It can be reinvested back into the business, fueling growth and expansion, or it can be distributed to shareholders as dividends. It's the lifeblood of a business, the ultimate measure of its financial health. The interplay between revenues, costs, and profits is crucial to understanding a company's financial performance. Remember, a well-performing company is not just about high revenues or low costs. It's about the balance, the harmony between all three. It's about the dance. Operating expenses and net income are next in line. In the realm of finance, operating expenses and net income are two elements that demand close attention. Operating expenses, often referred to as OPEX, are the costs involved in running the day-to-day operations of a business. These can include things like salaries, rent, utilities, and depreciation. It's the money that keeps the lights on, so to speak. On the other hand, net income is the proverbial bottom line. It's what remains after all the costs, including operating expenses, are subtracted from the total revenue. It's the profit that a company makes after everything is said and done. So, how do we analyze these elements? Well, for operating expenses, we look at the total amount and how it changes over time. If operating expenses are increasing faster than revenues, it may indicate inefficiency. The business might be spending too much on its operations compared to the revenue it's generating. It could be a red flag that the company needs to streamline its processes, cut costs, or increase prices. Net income, meanwhile, offers a snapshot of a company's profitability. It's one of the most scrutinized numbers in a company's financial statements. If net income is positive, the company is profitable. If it's negative, the company is operating at a loss. By comparing net income over multiple periods, we can see if the company's profitability is improving or declining. But why are these elements important? Simply put, they provide insights into a company's financial health. High operating expenses can eat into profits, leaving little left for shareholders. Meanwhile, a high net income could indicate a successful business model, efficient operations, or a strong market presence. In conclusion, operating expenses and net income are more than just numbers on a page. They are key indicators of a company's financial performance and can help us understand whether a business is thriving, surviving, or heading for trouble. Operating expenses and net income provide further insights into a company's profitability. Now that we've broken down the income statement, let's summarize what we've learned. We began our journey by introducing the concept of income statements. These financial documents are crucial for businesses, investors, and financial analysts alike, as they provide a comprehensive view of a company's financial health. They tell the story of a company's earnings and expenses over a specific period, shedding light on its profitability. Next, we delved into the components of an income statement. We learned that it's composed of revenue, cost of goods sold or services rendered, operating expenses, and net income. Each of these elements plays a vital role in the overall picture of a company's financial performance. We also discussed the importance of analyzing revenues. Remember, revenue is the total income generated by the sale of goods or services. It's the starting point of an income statement. But it's not just about the amount of revenue. The source and sustainability of that revenue are equally important. Then we explored costs and profits. We understood that the cost of goods sold or services rendered and operating expenses are deducted from total revenue to determine gross and operating profit, respectively. These figures give us insight into the company's efficiency and its ability to generate profit. We concluded our discussion by evaluating operating expenses and net income. Operating expenses are the costs incurred while running the business, excluding the cost of goods sold. They can include salaries, rent, utilities, and more. Net income, on the other hand, is the bottom line. It's the amount a company earns after all expenses, taxes, and costs have been accounted for. Understanding each of these components and how they relate to each other is essential in analyzing an income statement. It's like piecing together a puzzle. Each part contributes to the bigger picture. With these steps, you can confidently analyze an income statement. Keep practicing and you'll become a pro in no time.